Hi friends, in our previous video we got introduced to the topic final accounts adjustments, where we learnt about the need of adjustments and the items which requires adjustments while preparing the final financial statements. If you have missed the video, I am giving the link of the video in the description below. Please do watch the same to get a basic idea about the adjustments in final accounts. If you have not subscribed to my channel, please do subscribe and press the bell icon to get instant notifications. Please do share to your friends who are studying in higher secondary to whom this may be useful. Now let us look into the first adjustment, that is closing stock. Before looking into how we need to adjust for closing stock, we need to know why closing stock is an item which needs adjustment. Usually, there is no account to show the value of goods lying in the godown at the end of the year. However, in order to correctly ascertain the gross profit, the closing stock must be properly taken and valued. To substantiate this statement, let us look into the trial balance of RAM for the year ended 31st March 2020. As you all know, trial balance is the summary of all the ledger balances on a particular date. Here you can see the balances of several ledgers, but closing stock is not available here. But practically, at most of the times, inventory will be lying in the godown. Then, where are those inventories shown in the trial balance? If we closely observe, all the goods purchased are shown under the head purchases, and the stock remaining unsold in the godown also included in this purchases only. But in order to ascertain the correct profit position, the value of closing stock included in this purchases must be segregated and accounted as closing stock, because we should account for the expenses only to the extent of sales that have taken place. In our trial balance, we can see that sales is rupees 5 lakh. Let us consider that we have sold goods costing rupees 3 lakh. So the remaining 50,000 worth goods needs to be shown as closing stock and not as expense during the current period. There are two methods by which closing stock can be adjusted. First, let us see method 1. Method 1. In this method, closing stock is adjusted by crediting it to trading and profit and loss account. First, by crediting it to trading and profit and loss account, and by showing it on the asset side of the balance sheet. The adjustment entry would be closing stock account debit to trading account. Here, why do we credit the trading and profit and loss account with the closing stock? This is to reduce the value of the closing stock from the purchases. First, we have the entire purchases of the year debited to the trading account. So, while crediting the value of the closing stock in the trading account, we will be accounting the exact purchase cost. Now, this closing stock becomes the opening stock of the next year and is reflected in the trial balance of the next year. So, let us have an example to understand this method 1. In this first method, we will be crediting the closing stock to trading and P&L account, and we will be also showing it on the asset side of the balance sheet. So let us get into the example. This is the trial balance which we are considering, and as an additional information, we are given that the stock on March 31st, 2020 is rupees 50,000. Therefore, the adjustment entry would be closing stock account debit rupees 50,000 to trading account rupees 50,000. So as a result, you can see we are crediting our trading account. This is our trading account. We are crediting it with the closing stock rupees 50,000, and this is the balance sheet. Here we are showing the closing stock rupees 50,000 in the asset side. To gain more understanding, let me explain like this. The total purchases for the year is rupees 3,50,000 and the sales is rupees 5 lakh. This 5 lakh is the sale value. The relevant cost for the materials sold is rupees 3 lakh, as I earlier said. So only 3 lakh needs to be accounted as expense. But we have accounted rupees 3,50,000 the entire purchase as expense. So now we are adjusting it by bringing this closing stock in the credit side rupees 50,000. As a result, a net expense of only rupees 3 lakh gets accounted. If we don't have this closing stock here, the total of the credit side would be rupees 5 lakh and the total of debit side would be 3,50,000 plus 45,000, that is 3,95,000 rupees. So as a result, the gross profit would be rupees 1,05,000. But that is not the correct gross profit. Therefore, by accounting the closing stock of rupees 50,000, we are arriving at the correct gross profit of rupees 1,55,000. I hope that you are understanding the concept behind this adjustment. As I earlier said, there are two methods for adjusting the closing stock. We have completed the first method. Now let us get into the method 2. Here we adjust the closing stock by adjusting it through the purchases account. Therefore, the resulting entry would be closing stock account debit to purchases account. This entry reduces the amount of closing stock directly from the purchases account, and the resulting purchase is called as adjusted purchases, which is shown on the debit side of the trading and profit and loss account. In this mode of adjustment, it should be noted that the closing stock will not be shown on the credit side of the trading and profit and loss account, as it has been already adjusted through the purchases account. Another important point to be noted in this context is that when the closing stock is adjusted through the purchases, the closing stock shall appear in the trial balance not as an additional information or as an adjustment item, and the trial balance also contains the adjusted purchases. In such a situation, the adjusted purchases shall be debited to the trading and profit and loss account. Now let us have an illustration to understand this method. To have a better understanding, I am displaying the trial balances under both the method. This one is for the first method and this one is for the second method. So in the second method, we will be adjusting the closing stock with the purchases. So we have the journal entry closing stock account debit to purchases account. In the first method, we have the entry as closing stock account debit to trading account. But in method 2, we are directly adjusting the closing stock with purchases. So you can see that in the trial balance, you will have closing stock as an item. Whereas in the first method, you won't have closing stock as an item in the trial balance. It will be only as an adjustment. But in the second method, you will have the closing stock within the trial balance itself. And you will have the purchases as an adjusted purchase. That is, from the total purchase, the closing stock will be deducted. So you can see here, purchases is rupees 3 lakh. Whereas in our first method, we had purchases as rupees 3,50,000. As we have rupees 3,50,000 in the first method, we credited the closing stock of rupees 50,000 to the trading account to reduce this 3,50,000 purchases to rupees 3 lakh. Whereas in our second method, we have already adjusted this purchases to rupees 3 lakh. So in the method 2, we will be having the adjusted purchase in the trading account, that is rupees 3 lakh. Since we are accounting for only the adjusted purchase, the closing stock will not form part of the trading account. But in method 2 also, you will be having the closing stock rupees 50,000 in the asset side of the balance sheet. So let me once again tell you the differences between the two methods. In the first method, closing stock will be shown as an adjustment item in the trial balance, and you will be having the entire purchases in the trial balance. In method 2, closing stock will form part of the trial balance, and the purchases that forms part of the trial balance is adjusted purchase. With respect to trading and profit and loss account, the first method you will be having the entire purchases accounted, and you will be having the closing stock credited to the trading account to account the correct purchase. Whereas in the second method, you will be having the adjusted purchases being debited to the trading account. As a result, the closing stock won't be credited to the trading account. So here you can see 3,50,000 being debited and 50,000 being credited. The net effect is rupees 3 lakh debit. And in method 2, already we have adjusted the purchases to rupees 3 lakh. With respect to the balance sheet aspect, there will be no difference. In both the methods, we will be showing a closing stock of rupees 50,000 in the asset side. Friends, I hope you have understood the adjustment for closing stock. If you have any doubts, please do leave it as a comment below. Please show your support by subscribing to my channel. Also, press the bell icon to get instant notifications. Let's make accounting simple.